Good day, ladies and gentlemen, and welcome to our class on oscillators. And please take a second and click on the subscribe button down below or hit the icon bell and you'll be notified every time I upload a new video. So please subscribe to my YouTube channel. So the question is, why are oscillators important and what are oscillators? Well, oscillators fall into the field of technical analysis. Well, that's a scary term, technical analysis, and it's a very big field, and most people just assume indicators and oscillators are the entire part of technical analysis. But another way we can rename technical analysis is chart analysis. It is anything and everything you do on a price chart. If you're simply looking at price on a chart, you're actually performing technical analysis. Putting a trend line on a chart is technical analysis. Whether you're looking for triangle patterns or you're looking at historic prices on a chart, all technical analysis. So there's lots of different sectors. One of the small sectors, which gets a lot of notoriety, is technical indicators. Now, in the field of technical indicators are mathematical calculations that are plotted on either over top of price chart like Bollinger Bands, or like moving averages, or underneath your chart like Stochastics, MACD, RSI. They can be in either case. Now, oscillators are a unique field or a unique grouping of a specific type of indicator. So oscillators are one of the most interesting groupings of technical indicators. They are designed to signal overbought and oversold levels. Oscillators are a family of indices that go beyond the mathematics. They focus on one important thing, and that is momentum, and more specifically, changing momentum. Before we delve into which oscillators are best used and how to let me save you some unnecessary pain, let's first define what oscillators aren't. Some traders believe that oscillators are some sort of magic index. And nope. Rest assured, when I tell you they are not, oscillators' main use is not to tell you whether to buy or sell. Rather, they alert you to when it might be a good time to execute a buy or a sell strategy. But that is a big difference. So what they're doing, they're hitting you on the back of the head and saying, hey dummy, there's an opportunity here, check it out. So those who attempt to use oscillators as an ultimate buy or sell signal should be ready to learn a tough lesson. Those that will use it to fine-tune their timing, however, will find that oscillators are a very powerful tool. So if we think of technical indicators as exactly what the word is, indicators indicate. They indicate something. They don't tell you to do something. Or you can think of indicators as the interpreters. When you can't figure out what price is trying to tell you, or price is speaking a foreign language to you, that indicator might work well as an interpreter. So think of indicators as like when you use Google Voice Translate. You can't understand what the other person's telling you on the other end of the phone because they're talking a strange language. Google Voice Translate can give it to you in a language you understand, but it's not always right, but you get the gist of the conversation. So indicators are the most powerful, useful tool in technical analysis. They define precise moments to buy or sell. Like I said, alerts. In finance, technical analysis, a lot of different indicators are used, but most of them double each other since they signal the same upcoming events. A whole variety of financial indicators could be split into three classes: trend following, oscillators, and others. Okay, yeah, that's an easy way to do it. There's certain ones that are momentum indicators. There's certain ones that are speed indicators. Speed is important. When an uptrend is trending, you want to know how fast it's moving. Okay. When a momentum oscillator, a momentum indicator, is like firing a rocket into the sky. At some point, it's going to lose its momentum, or the momentum will fade. We know at some point it will turn and come back to Earth. But we don't know at exactly what point. Now, scientists can calculate everything and tell you precisely, except they're never right. It's like predicting the weather, because a rocket, or say a firework you're shooting up in the sky, is going up, 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 and you can actually visually see it slowing down and losing its momentum. But it could hit a hot air pocket. It could get caught in a gust of wind. It can be carried a lot farther up before it turns back down to Earth. There are lots of reasons that this can happen. So we can see that it's losing its momentum, and knowing that something is losing its momentum is very, very important. So Forex oscillators show firm market turning points and may send out untimely or false signals on moving markets. Other indicators monitor the state of investors' mass psyche. Being synchronous or anticipatory indicators, oscillators usually change before actual price change. So oscillators will help us see when there is beginning to be a shift in the marketplace before we can actually see it in price. Now, some of the most commonly used oscillators or indicators are stochastics, RSI, CCI, rate of change, momentum indicators, force indicators, and there's others. Now, Forex oscillators show us the momentum or the moments when the Forex market reaches its limit in any direction and opposite correction of the trend becomes extremely probable. This simply means that the price will stay stable or even slide down for some time because traders are willing to fix their profits. And during negative corrections, new traders will enter the market rising up with price. So in other words, an overbought or oversold indicator can remain an overbought or oversold indicator for quite some time. It can ease back out of it and turn around and go back into its reported levels. Now, there's another important element in oscillator analysis, which is also very important. Oscillators are used not only to discover overbought and oversold conditions, but to foresee breaking points in a price momentum. Some of them are mathematical transformations of price, first and second order derivatives, and on graphs their lines usually move in the same direction as price. Some analysis of Forex oscillators consists of two basic elements. First, discovering if the Forex market is in the short-term overbought and oversold condition. And second, determination of dispersion with the price as the value of the oscillator approaches extremes. Oscillators are most beneficial when the Forex chart are not showing a defined trend in either direction. In other words, what are they doing? They're interpreting this price action because we can't see it. It's too tightly wound. In trending markets, oscillator signals may be taken with maximum caution, provided that false signals generally stand for strength in the trend. So the next rule of oscillators is that on upward trend, oscillators show overbought conditions, or vice versa. On a downward trend, show oversold. Major graph software, most graph charting software, will allow you to put many oscillators on your charts. But remember, an oscillator is any object or data that moves back and forth between 2 points. So just think of a little oscillator on the radio, the old radio waves going up and down. They're going to move up and down between two set points. In fact, we call them bounded oscillators. In other words, it's an item that is going to always fall somewhere between point A and point B. Think of when you hit the oscillating switch on an electric fan. Okay. Think of the technical indicators as either being on or off. More specifically, an oscillator will usually signal buy or sell, with the only exception being instances when the oscillators are not clearly at the either end of the buy or sell alert range. Now, stochastics, parabolic SAR, RSI are all oscillators. Each of these oscillators is designed to signal a possible reversal where the previous trend has run its course and the price is ready to change direction. So some of the most popular ones I keep mentioning are stochastics and RSI. Each of these indicators is designed to signal a possible reversal where the previous trend has run its course and the price is ready to change direction. A change in momentum is often a signal that the current trend is weakening. So in other words, if buyers are pushing and pushing and pushing and pushing, and an asset is moving steadily upward, and it doesn't have to be a harsh uptrend, it can be a mild uptrend, but the buyers are pushing it. At some point, those buyers lose their momentum. Doesn't mean that the price has tipped back down yet, but it's a warning sign to you. So a momentum oscillator can help you distinguish between reversals and just price fluctuations. MACD is another type of oscillator that is very, very popular. Stochastics, again. And in a minute, I'm going to show you a little presentation using all of these so you can understand how they are. Because they filter trades and they help determine a trend's direction. So please, I'm just going to remind you once more in the middle here, please subscribe. It's very important. So now we're going to take a look at the main oscillators and indicators and how we can combine them and interpret them together to come up with a trading decision.
RSI. The relative indicator 1, RSI, recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super trend indicator. The super trend indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. And now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.